All right, a little past the top of the hour. Let's get started, and I will welcome everyone again to the Brandis Center webinar addressing the endowment model. I'm Bob Schmidt, Executive Director of the Brandis Center. I'll be your host and moderator for today's event. I want to start with just a few important thank yous. First, thank you so much to all of our attendees for joining us and our two panelists. I'll introduce them shortly. Thank you also to Assistant Dean Wendy Hunter-Barker for your work in preparing today's event, and also the IT team here at the Rady School, especially Chris Blanchard. We couldn't host today's webinar without all of your work. Most important, I want to thank Charles and Renee Brandis. It's their generosity and vision that make the Brandis Center, its research in these types of events possible. So just a few things before I introduce our panelists and kick off our discussion. In terms of format, we'll go for about 50 minutes today, and we got an absolute ton of questions from you all as you registered for the event. So thank you very much. We'll use those questions as the foundation for our discussion over the first 35, 40 minutes or so. And then if you have other questions during the event, something new jumps to mind, just click on that Q&A feature, share them with us, and we'll try to hit as many of the questions that pop up during the event as we can in the last maybe 10, 15 minutes or so. If we don't get to your question, we'll try our best to follow up with you after the event. And I'm betting we generate a lot of content today. So maybe raise some new questions we'll have to investigate, but what I envision is using today's discussion, maybe some other research that we do to create a recap or a Q&A type piece that we'll write up and post to the Brandis Center website in the coming weeks. And on that front, if you'd like to receive emails from the Brandis Center, please contact me at rpschmidt@ucsd.edu. I just put my email address in the chat. If you join our email list, I promise we're not going to inundate you with things, but we'll send you new research as it comes out and alerts for these types of seminars or webinars going forward. We're looking into things, hosting things in the future, such as artificial intelligence and investing, social media and its influence on investment decision-making, and where investors can find attractive values in today's markets. A couple other things I got to share. We are recording today's event. So as a registrant, you'll receive a link to the recording maybe later this week or early next. And also checking the registrants, we've got a really diverse audience today. We've got asset owners, asset managers, consultants, advisors, and academics. If you're not familiar with the endowment model, I'll share a quick gross oversimplification to help set the table. Today, we're talking essentially about two approaches to portfolio construction. On the one hand, we have advocates like Bob Maynard who argue that liquid, simple assets such as publicly traded stocks, bonds, and cash can get you toward your long-term goals. On the other hand, Steve McCourt would argue that you can generate better long-term returns by investing in less liquid, more complex assets such as private equity and debt, hedge funds, and real assets. Again, that's oversimplifying it, but among the ways to frame the discussion is conventional versus alternative, liquid versus illiquid, and or simple versus complex. And it's called the endowment model because it was pioneered by David Swenson and Dean Takahashi at Yale University to manage that university's endowment. Now, some investors might still call it the Yale model, but to be clear, this approach is used today by more than just endowments and foundations. We're talking public pension funds, corporate pension funds, and even individuals are applying these techniques to build and manage their portfolio. So with all that in mind, I'll finally introduce our panelists. I'll start with Steve McCourt. He's a CFA charter holder, managing principal and co-CEO with Makita Investment Group. Steve works with clients in developing and executing investment policy and evaluating and selecting investment managers. As Makita's co-CEO, he directs the firm's business strategy and execution. This year, Makita celebrates its 45th anniversary. The firm is an independent, employee-owned investment consulting and advisory firm. Steve is also an industry advisory council member with the Kroner Center. This is another investment-focused research center here at UC San Diego's Rady School. So Steve, thank you very much for joining us today. In the other corner, Bob Maynard. was the longest serving chief investment officer for the Public Employee Retirement System of Idaho, better known as PERSI. Bob retired last September after nearly 30 years in that role. And during his tenure, he helped build PERSI's assets under management from about $2 billion to more than $24 billion. Bob also has served on various investment and philanthropic boards. And full disclosure, he's a founding member of the Brandis Center's advisory board. So Bob, thank you very much for being here today. And okay, as I mentioned earlier, we got a ton of questions from you all. I'll start with Steve. And I guess as we get into the conversation, we'll talk more about the how and the what. This question is, I think, more about the who. What type of investor is suitable for an endowment type model? And how do you know if you have the right structure to make decisions across conventional and alternative asset classes? Steve?
Great. Thanks, Bob. And thanks to you and everyone else behind the scenes that has done so much work to kick this off. Very, very happy to be involved in this. I think that first question is a very critical one because the endowment model, for all of its benefits that I'll express throughout today, certainly requires that an investor accept a higher degree of complexity and the monitoring and work that goes along with managing that complexity itself is a consideration for investors. So I think there's probably two areas I would point to highlight the types of investors that are appropriate to consider the endowment model. One is sort of a cultural point. The endowment model, if you take it sort of to the extreme, includes a lot of illiquid asset classes, includes very complex investment strategies, and includes a mix of those assets that really require the investor both to spend a lot of time to understand those investments. You shouldn't be investing in something you don't understand, of course, and to also monitor those investments over time. I think monitoring complex investments is a full-time job in and of itself. So culturally, the investor has to be willing to sign up for that. That's the ante for the endowment model. You have to be in it to understand and appreciate the investments that you're going to be with. Otherwise, if they go sideways in the future, you're going to abandon the strategy probably at the wrong time. The second prerequisite, I would say, is sort of resource focused, because the endowment model involves many complex underlying strategies and mixes of strategies. Successful investors that invest in asset classes using the endowment model tend to do so with very experienced investors managing the underlying strategies, and most often with large investment staffs or outside investment advisors that manage the managers for them. So there's sort of a oversight and monitoring hierarchy and organization that goes with the endowment model in most cases.
Okay, and maybe one follow-on question to that. I was looking at Swenson's book in preparation for this, Pioneering Portfolio Management, and if I read that correctly, he was contending this is not an approach that you can get your toes wet with. To him, I think it was all or nothing. Would you agree with that, or do you think you can have some more of these conventional, simple type asset classes and mix in some endowment model asset classes as well?
Yeah, I think most things in life are shades of gray. So I think the endowment model is no different. You can definitely integrate parts of an endowment model. You can integrate the full Monty, and you can start it with a small allocation and build up. I would certainly agree if the point is being able to define what the endowment model is. I would certainly define it as sort of the full bore model with many illiquid asset classes and complex strategies. So you can do things to kind of migrate towards that endpoint, but the endpoint, is probably best defined as the endowment model.
Okay, thank you. And Bob, over to you. Can you talk a little bit when you were at Percy, what type of culture you had there? Steve touched on the necessity to accept a higher degree of complexity, longer term focus, and resources. And how did you manage money at Percy, and how did the culture there, what you're trying to build, kind of tie to the approach that you used?
Well, it was Idaho, so I wasn't going to get large staffs and a lot of tolerance or patience for building an empire that would be required to do the endowment model. Swenson had started Yale process in the late 80s. When I got to Idaho in 92, it was you took a quick look at it, and it was very clear that there would be no way that at Idaho I'd be able to get the resources, first of all, the staff, secondly, we're going to be subject to Freedom of Information Act requests, which are a disaster if you're trying to do the endowment model and complex investments. The contacts weren't there to be able to do it. And Idaho at that time was a flaming pit. It was at the bottom of all rankings. It was it was under 60% funded, and it was in the headlines every day. So it was clear just getting back on track and getting into the pack was going to be a victory there. Now, the problem is also, too, and you brought it up in Swenson's book, but he wrote a whole book also, 2005, Unconventional Success, where he repeated that advice. It was, don't try this at home, kids, because it was the requirements in order to successfully implement an extremely complex model like they were attempting. And he did it in one of the Yale letters too. I think it was about 5 years ago. I said the exact same thing, because if you look at what he describes, and he also had a lecture in Bob Schiller's class. It's on Yale Online or whatever it is. And he describes basically what I call the Swenson J curve, that he believed that a good, solid, non-complex portfolio, stocks, bonds, credit, not a little bit of credit, mostly government bonds, and a little bit of real estate, that sort of stuff, could give you good, solid returns. And he described the J curve, that you could get good, solid returns with a standard conventional portfolio. And if done really well, the endowment model that he was doing, you had the resources, you had the people, you had the budget, you had the flexibility, you had the ability to keep things secret, you had the contacts, that you could get better. But the mistake was, and he describes it quite well, is the idea, well, if you have simple, if there's a straight line going up to this better return, this better approach. But he said no, and he's dead solid right. What happens if you go on the line of more complex, you don't start immediately going up, you start going down. It's a J curve, and only the people at the very end that do all of it right are the ones that really succeed. And that has been the case over time, because you add complexity, you add cost, you add false starts, you add a whole bunch of things going on. And then, as Steve mentioned, you're going to have something go wrong, and you're going to have political pressure to change. If you are, I always looked at it as a real return issue, that that the capital markets on a reasonably diversified 70-30 base equity fixed income, and reasonably diversified, maybe a little real estate, maybe, will get you about 3 to 5% real returns over 20 years. That's saying equity type investments will get you 5 to 7 above inflation, and bonds will get you 1 to 3. And that'll get you between 3 and 5 over 20-year periods. If you're in that swing zone, there's no need to go to the endowment model and its problems. But there are some endowments, I know in the Ivy League, friends of ours, who had 7 to 8 to 9% real return requirements.
Sure.
If you're in that class, you got to go to Vegas. You either go endowment model or you go to Vegas and put it on red, or one of the two. The other is if your time period, you can't wait out the slings and arrows of capital market misfortune, and that's you got to be able to say my time frame is 15 to 20, and I can keep at it.
Okay. On that front, we got a question in the Q&A already about the size of the endowment and does that impact the approach? And from what I've heard, maybe less so. I think it's more of, do you have the resources, the stomach, the long-term approach for that endowment model? At the same time, I've looked at the NACUBO studies, and it seems like the more assets you have, the better accessibility you have to endowment model type assets. So maybe flip it back to Steve. Is size the issue here, or is it more the other factors that we've touched on?
I want to joke here, Steve.
I think it is, at least indirectly, particularly if you're going to be implementing the endowment model in kind of a pure way with the highest chances of success, because the reality is you need to be of a certain size to support the resources to run the model itself, and you have to be of sufficient size to really get access to the underlying strategies in a cost-efficient way, to allow for the best outcomes from the model. My really kind of crude estimate would be something in the $500 million range. If you're below $500 million, you will come across increasing numbers of constraints in implementing the endowment model. Doesn't mean you can't do it. It just means that you're going to be more challenged because of your lack of scale and size. Over $500 million, it gets easier. And then probably once you hit about $10 billion, it starts getting really tough again, because at that point, scale works against you. You can't allocate to the best managers at the scale that would be required to implement the endowment model. So there's sort of a sweet spot in terms of size for the endowment model.
Right. Or you can't get enough of those assets to move the needle significantly for your total return.
Right.
Yeah. All right. This also, it kind of ties in and other questions that we got. One was, Swenson has argued that illiquid markets provide a much greater range of mispriced assets. And, with the Brandis Center, we really focus on value investing, price versus value. This notion of mispriced assets in private markets or illiquid markets, is that still true? And if so, where are the best opportunities today? And I'll start with Steve, if I may.
Yeah, I'm gonna say it's probably not that true. I view it a little differently. I think it was true 25, 30 years ago, that all else equal, assets that were not in the public markets were more mispriced. I think today there certainly is a little more mispricing potential in the private markets because they're not as liquid. But the reality is companies that trade in the private markets are all competitively priced. So it's not, I wouldn't define it as a incredibly inefficient market. It's certainly less efficient than the public markets. But I view the real distinction between the private markets and the public markets less about efficiency, because that efficiency argument kind of gives you the sense of, well, all you have to do is buy a private company and sit on the liquidity premium for 20 years and you're going to beat stocks. I don't think that's the way it works. The real difference in the private markets relates to the degree of control and influence that a owner in the private markets can more often than not have on a company that they own. When you're an owner of a public company, you're a passive owner that relies on management to make day-to-day changes to strategy, policy, and execution of that company. Private equity managers or real estate managers in the property markets or infrastructure managers in the infrastructure markets, when they buy an asset, they're generally taking more than a 50% stake in that company with a defined strategy in advance to extract a certain amount of value out of that company in the next 5 to 7 years. So it's an active strategy that provides, I think, better potential than the public markets of owning equity passively. So that's part of why I think the premium exists over time. The other piece is a premium. I wouldn't really relate to public versus private as much as I would relate to just size. There's a size premium in the marketplace for equities, and it, over time exists in the public markets, and over time it exists in the private markets. And to the extent that private companies, based on revenue and EBITDA, are smaller than companies that trade publicly, they're going to be somewhat cheaper to buy. And if you buy them at a smaller scale and you grow them over 5 or 7 years, you're going to sell them at a higher multiple. And so that's another sort of value accretion mechanism in the private markets that doesn't exist as much for most public market investors today that are really focused on large liquid companies. So long answer, but I think there's a premium to the private markets. I just don't think it's based on inefficiency of pricing as much as it's based on other dynamics of how owners of private businesses can extract value from the companies they own.
Okay, interesting. Bob, any points to share on the heels of that?
Darn, I have to agree with Steve on everything he said. I remember back in the early 90s when the VA model was just starting out, most of the Ivy League tried to go, and a good friend of mine was Alan Bufford, who was doing the MIT, and he whined all the way through the 90s about how all the low-hanging fruit they were getting was being raised higher, being picked, and now you had to be a giraffe to get the fruit off the trees. And I agree with Steve that right now it is extreme. It is just as competitive to try to find a good, solid private company and buy it away from the competition as it is to find a micro cap or a small cap stock. There was a great study done about like 3 years ago about public to private acquisitions. And the article was saying, well, you can replicate private equity returns by simply looking at the type of companies that were public to private, buy them public, and you'd outperform the market. Well, I looked at it the reverse. The way that private equity buys in the smaller cap space, whether public or private, had a certain discipline, had a certain approach that did outperform the market during that time frame. Now, whether or not those conditions still exist is a different issue. But for all the reasons Steve was saying, simply going into private by itself randomly ain't going to do it.
Right. And this is all great stuff, and it kind of ties to another question that we got again as people were registering, and the question was, we're talking about asset allocation, but it seems to me this is more a conversation about manager selection. How can you pick a good, we'll pick on private equity, good private equity manager, for example, or I could say a good active manager on the public equity side. So I don't know who wants to take this one first. Like, how do you find these good managers, whether it's private or public?
I'll start out. There's a very big lake woebegone problem here. Everybody is better than average. Being smart, articulate, well-resourced, having a successful track record, and having good contacts simply gets you in the game. And then it's a competition between all of those. And I guess my only advice is you better not count on your managers if you're not going to get there with your underlying broadly indexed approach. Because I've been in this business. I'm not the dumbest guy around, but I think I'm at least adequate. I can tell the good from the bad. I can tell the pro from the amateur. I can't tell the great from the good, particularly in advance. And as a result, I just want to be able to understand them and see whether they're doing what they should be doing under the circumstances. But counting on active management to get you to your goals by you being able to pick the great from the good, because you got to pick the great in order to actually outperform the standard markets, I think is a errand that should be low on your list of priorities.
Steve, your thoughts?
Yeah, I think in terms of the factors, there's, in my mind, similar, if not identical, or close to identical factors that one would look at to identify stronger managers in the public and the private markets. And I think those are well known, and they generally relate to the experience of the team, the repeatability of the investment strategy that they're executing, et cetera. The two things I would highlight that are unique to private markets, and I think they're related, is number one, there in the private markets is a statistical degree of serial correlation in performance of different funds. So a fund that has superior performance tends to mean that the subsequent fund has a higher probability of having superior performance too. It's not a certainty by a long shot, but the odds are in your favor. And I think the main reason for that is there's an art to generating IRR through fund vehicles that private equity managers learn over time. When you look at the return profile of a first fund and a second fund and a third fund, averaged across kind of big numbers, you see that. It almost always in a first fund, there's tactical errors that happen, either in asset selection or in how fees and expenses are offset in the fund that have the end result of reducing IRR for the end investor. So I think managers learn the art of generating IRR through fund vehicles with time, and that's a big reason, along with experience, that there's serial correlation. Here's the challenge in private markets. The managers know their serial correlation, so as they have successful funds, they raise bigger and bigger funds and attract more and more capital to them. And so you have, over time, these behemoth asset gatherers that are naturally more challenged to deploy capital at scale because they've created fund sizes that are really, really difficult to generate high returns off of. So for an investor, the key is like finding that right middle ground. You ideally want to identify managers that aren't so early enough in their careers as private equity investors that they haven't yet learned all of the artwork of running funds and buying companies, but not so late in their career that they've diluted their ability to outperform by gathering too many assets and building big companies and all this. And so that's really the interesting artwork and nuance of it all. The other thing I would say, in perfect alignment with Bob, there's a I think a unfortunate belief in this marketplace, both private equity and used to be public equities. It's kind of gone away in public equities, that active management, that you have to invest in better than average managers to outperform. If you can't, you shouldn't be in there. I will tell you that half of all managers are better than average and half of all managers are worse than average. and no one can tell the good from the great. Bob's not alone in that. So the best way to mitigate your risk of being on the left tail of the distribution is diversification. Private markets are an area that you too have to diversify. You have to invest in lots of different strategies and lots of different managers. And that's part of what makes it complex. And part of the potential failure in the private markets is failing to diversify across funds, companies, managers, vintage years. Because if you're overexposed to any one factor, you can really find yourself on the left tail of that distribution. So I think doing your best to focus on the factors that are somewhat forward-looking in terms of investment success, and then diversifying your investments in those areas.
Okay.
I would like to emphasize one thing Steve said. He's dead solid right. The tough part, most of the private equity people out there pick good companies. Simply picking a great company early on is by far means not enough. You've got to know how the business to run a private equity fund all the way through. So on subsequent rounds, you don't get diluted. So you know how to keep the powder dry. So you know how to do a number of things that are not intuitive. If you simply say, I can pick good companies, so therefore I can be a private equity. That's the least of the problems. The other problem is, and this happened in real estate back in the 90s. I swore off back in the 90s of never going into a blind, commingled real estate fund, because the problem is the people you go in with are, after 10 years, none of them are around. So you have a turnover within the company, and you see that in private equity, where you have turnover. So the people you end up with for the next round don't turn out to be the same people on the previous round. So you got to hit them on a sweet spot, and that sweet spot doesn't necessarily last. And the last thing I'd say on public equity, I always wanted a public equity manager who had been through a crisis and had come through it. I mean, every public equity manager is either going into a crisis, is in crisis, or has just come out of one. And you've got to see someone go through that, because people who have never had a crisis, you can't trust them when the next crisis arises, which may be now.
Yeah, those are great points. And Bob, for so many reasons, you're the exception to the rule in the industry. You were at Percy for what, nearly 30 years?
30 years.
Yeah.
And then a permanent fund about 5 years before that.
Yeah, I mean, the things that I've seen, the chief investment officers are around for maybe 4 to 5. If that,
3 to 5 is our life.
Tough to implement a long-term investment strategy when your career risk might limit your vision to, again, 3 to 5 years. So you all touched on some really good stuff. Thank you. And something that Steve had mentioned about the returns that the early funds are generating gives them greater likelihood, again, no guarantees, that they're going to do better going forward. We got a number of questions about transparency and valuation, and some really skeptical, quasi-cynical questions saying, what about the lack of transparency? Again, picking on private equity. This person said to me, this can be a huge advantage for publicly traded assets. We hear stories about private equity managers, for example, marking the prices for assets to whatever they want and then charging outrageous fees on top. How do you guard against that? So how do we get transparency in the returns that these private equity firms are reporting?
I'll go first and Steve will give the right answer. I think the problem with transparency as to what private equity funds are doing is much less than it was. It's terrible. I agree, still terrible, but it's much less than it was in the 90s. And it's getting a little bit better, but it is still a huge problem. And that's the biggest problem. The transparency of the public markets is not just a matter of, to me, it's the best risk control. You have a million eyes looking at what you have, and you have a consensus as to what the value is. You don't have those million eyes in the private equity. And there has been historically a tendency for private equity managers while there's some oversight with regard to what they can value and how they have to mark to the public markets, the personality is that of squirrels. When times are really good, they'll hide some of the nuts for later on. As they come up for another funding round, you'll have less than full markdowns. I'll be interested to see after a year and a half before what happens in the next 2 years, because that's going to be the big test on private equity valuations as they have to dispose. So yeah, it's a big problem. And I think it's a reason not to have a huge amount of, like having 30 to 40% of your stuff in private equity with hundreds of relationships, a lot of stub private equity firms, difficulty in getting out, and the illiquidity in a crisis. Heck, Yale and Stanford and Princeton had to bond during 2008, 2010, simply to meet the requirements to give the money to the university because they were so stuck up. Hell, Harvard was selling their portfolio at a discount simply to make the nut on the what they had to transfer to the university every year. L. Arian was completely incorrect when he said they were really long-term investors. If you had 30% of my organization dependent on my yearly returns, I'd be tight as a tick. So, I mean, there's all those issues on the transparency as to what you have. And you're seeing it now on the hold to maturity crisis with the banks. So
yeah.
I'll stop there.
Okay. Steve, any thoughts on that whole?
Yeah, I actually think transparency is pretty good in private equity. That's been our experience for the last couple of decades. If you're an investor in a private equity fund, you get very strong transparency into all of the assets that are owned by that fund. It's incumbent upon you to sort of ask the right questions and request the right documentation, but it's pretty strong real-time transparency. It's not at all transparent to outsiders who are not investors in that fund, and that's one thing that makes it very different than public equities. But the valuation issue and comment is certainly an important one, and this has changed over time culturally in the private equity landscape. I know Bob knows this as well. It used to be that private equity valuations were on average much more conservative than public equity marks, mostly because general partners never wanted to negatively surprise their limited partners. And that's changed culturally in the industry in the last decade or so, mostly because for the larger buyout funds and larger venture funds too, management fees are a larger part of the revenue they receive, and that's created some misalignment in the activity of general partners. There's been studies done that have shown that there is an upward bias to valuations when private equity managers are in the process of fundraising. It's not because they want to elevate their management fees, it's because they want to show their fund as top quartile based on unrealized returns when they're marketing the new fund. But those same studies also state that when a manager is not fundraising, valuations are not elevated. I think if you go into the valuation and performance attribution process, just knowing that there's incentives to mark up unrealized assets somewhat, you'll do yourself a favor. There is, these are tethered though, and that's an important point for your audience here. General partners are generally required each year to have their valuation processes and results audited once a year. They then update that less formally quarterly. So generally what happens in the private equity industry is you get muted marks at the end of the first quarter, second quarter, and third quarter. And it's at the end of the fourth quarter where you get kind of a real serious review of each of the assets. And so there are third-party objective auditors looking at the valuations of the vast majority of private equity funds. There's written opinions that come with those valuations. But the challenge is that even within an audit, there's sort of a range of reasonable valuations, and depending on where the general partner is on their fundraising cycle, they might choose on the higher end of that range.
And they can maneuver that. It tightens the range they can maneuver in quite substantially. I agree with that. So, Steve, after the market, private equity has not yet reflected all of the losses of the year. That was a disaster year for a lot of the people that were in public. How much? And the numbers I'm seeing come in, there's a lot of down draft right now on the valuations. How much longer do you think, is it going to be another year before we see the private equity valuations reflect? And do you think they will fully reflect, or simply cushion it a bit on the downside to kind of smooth out the issues?
Yeah, it's going to be interesting. The really unique year, Bob, you probably know, for private equity was 2021.
Oh yeah. If you didn't make 50%, you were nowhere around.
Yeah, historically, like a clock, private equity would underperform public equity when public equities were up a lot, and it would outperform public equities when public equities were down a lot. And the main reason is that the valuation processes just result in less extremes in valuations than you have in the public markets.
And by the way, that's why I always love having some private equity. My accountants would recognize it. My auditors would recognize it. My actuaries would recognize it. It may be a phony happiness, but it made me happy. I just want to think
I fully agree. 2021, I'll get the number slightly wrong, but roughly the public markets were up 30%. And in a year like that, you would normally expect private equity to be up 15 to 20%. It was up like 60%. And some of that was crazy crypto stuff in the venture world and growth equity, but a lot of it was traditional buyouts that just had really high marks. And so I mentioned that because I'm sort of in your camp, I'm assuming here, Bob, that it feels to me, I have no evidence of this, but it feels to me that there's more of a valuation write down that's required because of all the write up that happened back in 2021. Now the question is whether the valuation gap between public and private occurs in the context of public markets going up and private equity valuations just staying the same, or public markets doing what they're doing and private equity valuations going down a lot more. I think, but my best guess at this point is that private equity valuations will go down, but not that significantly, unless we have a hard landing recession. And so far, based on the fundamental data of privately owned businesses, revenues and EBITDA through the end of the fourth quarter, there's just operating performance is still strong. So I think it's very hard for general partners to seriously mark down their assets when operating performance is down, even in the context of higher interest rates. I think there's other sectors that are more challenged in that regard, like commercial real estate in the institutional world clearly has to be written down because those valuations are much more tethered to interest rates, which have obviously gone up. And so all the private markets have done extraordinarily well relative to public markets in the last year. There's got to be a mean reversion, but I don't. My guess is that the mean reversion in private equity won't be as severe as some fear, and it probably won't be as significant as you would see in some other private market sectors like real estate.
Well, you guys touched on a really big point, and we got this question quite a bit as well. With interest rates having gone up so much last year, still ticking up this year, which approach is better suited in that environment? Whether it's rising interest rates paralleling a rising inflationary environment. You guys want to tackle that one?
You want to repeat the question? I didn't quite get it all.
In a rising interest rate, rising inflation environment, which approach is better? More traditional public assets or less liquid, complex private assets?
Yeah, so maybe I'll start, Bob. From a starting point of right now, given where real interest rates are and valuations are, a traditional 60-40 portfolio has more advantages than it's had in a long time. I would still argue the endowment model will outperform over time, but the endowment model had a lot of advantages if you had started a couple of years ago, given where valuations are between public and private and interest rates at zero. So right now a 60-40 portfolio, probably has a long, based on our modeling, a long-term expected return of say 6 to 6.5%. 2 years ago, that number would have been 4%. So you can get a lot more out of a 60-40 portfolio than you could have just a couple of years ago. And to the initial question and comments on it, if your institution only requires a 6 or 6.5% return, you can get it with a traditional non-endowment model portfolio. You could also get it with an endowment portfolio, and you could probably do a bit better than it. But I think there's more reasons to do a traditional 60-40 portfolio today than there were 2 years ago.
Okay.
We're so 1970s. The 60-40 portfolio has been 70-30 since easily. And now most people who are doing that traditional portfolio are 80-20. So
indeed, yeah.
And so you can get it up. You can get it up to like 5% real, given a traditional portfolio. You can't switch into and out of a endowment to a traditional portfolio. I think the question right now is now the time to do a conventional versus a traditional portfolio. In my mind, neither. Right now, I have until never fight the Fed. Every time the Fed hits the brakes, someone flies through a windshield. We're still in the middle of that type of process, and so I kind of hold powder dry for at least another year. This feels to me like it may be over, but it feels to me like after Bear Stearns and before Lehman, that you're gonna, because it's too much of the hold to maturity, of the not take, basically on the banks you're saying, well, these are all paper losses. Anytime I hear of the idea it's only a paper loss, I run for the hills. And that's not only true of that, it's true of the loans, the commercial real estate loans on the banks. It's true of a lot of other outside of banking. I'm going to be interested to see how the corporate LDI movement has done, because a lot of that was matching your long-term liabilities with long duration bonds. And you saw how that blew up in Britain on that. I'm still wondering when that's going to happen. There's a lot of hedging strategies that were using long-term bonds. So I think there's a little ways to go, particularly if the Fed continues to raise rates. And I would be reluctant to make a big bet either on the old 70-30 portfolio or on the to the endowment model for another year or so.
Okay. Hey, we're coming up here on 50 minutes. I'll go a little longer. If y'all are up for it, we'll go top of the hour, because there's still a handful of questions that I want to hit.
I'm retired. I have nothing else to do. This is my entertainment value for the next week. Steve has a real job now.
Maybe just a few more, and I'm trying to tie in some of the questions that we got in the Q&A, and thank you for those. Just on the fixed income side, somebody had a question about how did you invest your fixed income allocation? So with rates going up,
I did.
Yeah. And/or what would you recommend for today?
It's bonds, for God's sake. Who cares? I mean, you're over my long term, we're going to get the return off the equity interest, and bonds and fixed income are there as the Armageddon hedge. So we never really had a separate allocation to Sri Lankan high yield bonds, for example, or whatever you may do. We didn't look for bonds for the returns. And so basically it's a safe haven. We had 30% in bonds, and That was where we dipped in whenever we wanted to reallocate after equity losses when we had huge volatility, whether that be in the late 90s, the early 2000s, 2007, 2009, you want it to be there. I will say that one of the most fascinating, if you'd have told, in my career, I would never have thought I'd have heard the term treasuries as a toxic asset. If you'd asked me that 2 years ago, I'd have bet we would have really defaulted on our bonds. So this is a fascinating period for fixed income. I'd stick low duration and wait out the next year and a half.
Okay, Steve, any thoughts? And hey, and I'm still sitting on that slide that you shared.
Yeah, I don't think we need. I just looking at a couple of questions. There's a question in the box about how the endowment model has performed. Right now is not fair. There's a concept in the capital markets called endpoint bias, and right now we're at a point where the endowment model historically looks like it outperformed a 70-30 traditional portfolio by 3, 4, 5 percentage points per year, compounded over 20 years. If we looked at that same data 4 or 5 years ago, it would have been closer to neutral. So right now, the performance of the endowment model looks extraordinarily superior. But a lot of that, as we noted before, just relates to the fact that valuations in the private markets haven't quite settled yet. And we'll see, in a couple of years where things settle out, both on the public and the private side. My strong suspicion is that the endowment model will have higher returns over time. And on an accounting basis, for sure, have lower risk. So it'll be superior. But I think right now, it's not as good as the numbers look. It's still very good. The other question, Bob Schmidt, I thought was interesting, and I wanted to ask Bob Maynard this question too, because I find it unusual that this hasn't gotten more scrutiny in the investment world. U.S. versus international stocks. Mm-hmm. This was a debated issue in the 80s and 90s. Everybody kind of went all in on international, and they've done awful for 15 years now. Like, what's your perspective, Bob, on the benefits or lack thereof of international equities?
Yeah, I wrote about this a number of years ago. I've always had a U.S. bias. One, our liabilities are in the U.S. Two, well, for a number of reasons, the U.S. market is well enough diversified. But three, I'm almost of the opinion, I've been of the opinion that there may be a peculiarity of the, I'll call it the Anglo-Saxon economic model or whatever. One, we've never lost a world war, that kind of helps. But you go back long term, it isn't all that clear to me that international necessarily has an advantage or even an equality with U.S. markets over the long term. Warren Buffett, remember his 2013 shareholder letter when he was talking about the Widow Buffett portfolio, 90% S&P 500, 10% intermediate bonds, and it'd be any institutional. And I think, by the way, he's been right since then. So I think for that reason, international hasn't lived up to the hype that it was given in the 80s, 90s, and the early years. And in private equity, by the way, that always disturbed me, is that all of a sudden when private equity was going through one of its down periods for that 5 or 8 year period before it really blew back, you're dead solid right on the end period bias. All of a sudden, the consultants, you guys have been there too, all of a sudden did public market equivalents, but the public market equivalent they were doing their private equity against was the world benchmark, not the US benchmark. And I think you'd have gotten a completely different comparison if it had been the other way around. So yeah, no, it is an interesting question going forward as to whether or not international diversification is worthwhile. But then again, you had that problem with emerging markets all the way through the 90s. And then it blew out everybody for the next 10 years, and then it went underground again. So there could be a big end period bias on my views on this one too.
Just my 2 cents on that, and this is certainly influenced by my years in the outside of academia, and I just joined UCSD last fall, it's company specific. You know, you start looking at individual countries, that can take you down the wrong path, but I always think you have a broad opportunity set. You're going to find some of those mispriced securities that we touched on earlier, and you give yourself a better chance of doing that if you have a global perspective. That's just
That's true, and the competition is more global, and the emerging markets are. No, but you know, history has been it's been a substantial outperformance by U.S. equities, so that's going to be interesting to see if that goes forward.
Hey, coming up here on top of the hour, I'll flip it back to each of you. Any closing comments or anything you want to share that we didn't touch on, that I didn't ask or didn't pop up in the Q&A or the chat?
I'll go first, and then let Steve wrap up with truly wise words. There's 1,000 right ways to invest. Whether the endowment or the conventional model, it really depends on your particular circumstances and your particular liabilities and your particular needs, how much you're subject to headline risk, whether or not the people you report to have other motives, the politics or whatever it may be. There's a whole bunch of things, so it makes it peculiar. Over a long period of time, I don't think it makes, if you can hold this, the key is being able to hold something through good times and bad. Steve mentioned earlier that the ability to hold to an investment strategy through the inevitable bad times rather than switching is the key. I remember there's a group for a while we said we will never be named, but it was NASIO, National State Investment Officers, where all of the U.S. state investment officers, chief investment officers got together. And we had a database going back 40 or 50 years. And we had, at one point, we brought up the top 5, and they were all different investment strategies. Some were simple like ours, some were very complex, some were highly private equity like Washington State. We all had about the same returns over 30 years. And it's my view that if you pick something that fits your culture, you can keep with, resource, not outrun your supply lines, all that good stuff. We all make the same amount of money, just a bit different times, within a reasonable period. So I think the debate really is, because the fact of the matter is, CIOs wouldn't get paid as much if you do a simple one versus a complex strategy. It makes you a lot more money if you're in the business. You get a brass ring. So I think there's a lot of merit to at least parts of the endowment fund model, but be very careful before you step in.
Thanks, Bob. Steve, over to you.
Yeah, thanks. You know, I think the keys to successful long-term investing are largely focused on avoiding mistakes. And the biggest mistake an investor can make is adopting a strategy that they or future constituents won't be able to adhere to in future years and decades. And the reason is because emotionally, investors tend to exit strategies at exactly the wrong time. Yeah. So whether it's the endowment model or the 70-30 model or other approaches to investing, it's really important when you look at asset allocation modeling and expected return, they're just numbers on a page. Really think through whether you or your board, if you're an institution, or future board members as an institution, will be able to fully embrace, understand, and appreciate the upside and the downside of that particular strategy. Because if they can't, every strategy has its day on the upside and the downside. And when that strategy is on the downside, you or your board will flip to the wrong strategy almost every time. So it's part of the fun artwork of what we do, is kind of working with boards to kind of figure out where that comfort point is. And it's a really important element of setting long-term strategy.
Yeah, that's really well said. And I'll close this out here with a quote again from Swenson's book. He writes, active management strategies demand uninstitutional behavior from institutions, creating a paradox few successfully unravel. You have to accept portfolios quote, which frequently appear downright imprudent in the eyes of conventional wisdom. And from what I heard from you both, it's knowing which strategy is appropriate given your experience, your resources, et cetera, and then having the long-term vision to stay with it through, as Steve mentioned, the inevitable ups and downs. So, hey, I just want to close here and say thank you to everybody who joined us. Of course, thank you especially to our panelists, Bob Maynard and Steve McCourt. I mentioned this earlier. My email is still in the chat. If you want to join our email list, we'll keep you posted on research that's coming out. We've got a new piece that's coming out called Echo Chambers. It's almost ready to go. I think it's going to be on the website in maybe a week or two. This is research led in large part by Rady Finance professors Dr. Joey Engelberg and Dr. Will Mullins, looking at the importance of diversity in research perspectives when making investment decisions. So we got a lot of stuff in the pipeline that's coming out. Again, I just want to say on behalf of everybody at the Brandeis Center, the Rady School, and UC San Diego, thank you. Thank you so much for joining us. We hope to see you again in the future. This concludes our event for today.
Been fun. Thanks,
Thanks,
Bob.
everyone.
Thank you, Steve.